Hi guys, it's Sasha. So I recently made a video highlighting how the incredibly popular Safemoon token is a Ponzi scheme, and unexpectedly that video got really popular. After setting impressive records for my tiny channel for the number of dislikes and 3,000 comments that at times showed a distinct lack of rational argument, I asked my audience if it's worth doing a follow-up video where I explain in a bit more detail some of the points that I didn't cover in the original video. The majority voted in favor, so here goes. Now, I know that this video is going to get exactly the same treatment, and I am okay with that. If you are a big Safemoon fan, I do, however, encourage you just to listen to the video first before you go and do your worst below, because there's some really important points that I want to make in the video so that hopefully you can hear me out. First off, I need to address an issue that the last video didn't make clear enough. Let me make it patently clear why my opinion is that Safemoon is a Ponzi scheme and why it is different to most other cryptocurrencies and the market in general. The exact definition of a Ponzi scheme from the Collins Dictionary is a fraudulent investment scheme in which funds paid in by later investors are used to pay artificially high returns to the original investors, thus attracting more funds. With Safemoon, the protocol relies on two specific ways in which this Ponzi effect is generated. The first one is the redistribution of Safemoon to existing holders every time that other people go and do transactions, specifically when new people go and buy into the ecosystem. Now, in order to sell out of your Safemoon position, the price has to go up by at least 20% in order to mitigate for the cost of buying into the position in the first place and then the cost of selling at the end. This creates an unfortunate objective for the holder of any Safemoon amount to pump the price because you start off in such strong negative equity. Now, the fact is, all the PR and all the marketing associated with Safemoon is literally telling you that it is going to the moon, which is a definition which sits a bit too close to the line of what I think is normally seen as acceptable by regulators, because it literally pretty much directly implies very high returns. So the design of Safemoon has these two factors that by definition, as I just explained, make it a Ponzi scheme. And then there is a very important point that seems to cause a lot of confusion. There is a very big difference between investing in an asset that has intrinsic value versus investing in one whose entire value base is solely based on speculation. If I invest my money in the shares of a company, then the company will be producing and selling products and goods and services and whatever it is they do for years and decades. And I, as a partial owner, will get to benefit from a share of those proceeds. Other asset classes such as commodities and currencies, they have utility. And this means that the asset has some kind of a function or a use. Oil, for example, is a raw material that can be producing energy, can be used to produce and manufacture lots of consumer goods, therefore it has a price. The US dollar has the utility of being a method of exchanging and storing value. You can easily sell and buy goods by using dollars as the medium of that exchange, and a lot of people around the world have a consensus that they are happy to use it. Safemoon, on the other hand, has zero utility, and this is another case where it's different to other cryptocurrencies. It doesn't even have theoretical utility because the 10% transaction fees mean it cannot reasonably be used as a method of exchanging or storing value unless the currency grows in value by 20% very, very quickly between the time when you get some of that Safemoon and when you next want to spend it. Can a currency that grows 20% extremely quickly have some kind of long-term future? Well, ask the Weimar Republic, Zimbabwe, or Venezuela as to what happens in those circumstances. Now, if the alternative happens and the rate of growth actually stalls, then you're going to get into a situation where every new buyer will be in perpetual negative equity, which is exactly how Ponzi schemes collapse. Now, the big question, can you make money with it? Because a lot of people misunderstood my point in the original video. Sure, every Ponzi scheme has winners, and some of the earliest entrants into the scheme will be the biggest winners, and a lot of people in this particular scheme will also make a lot of money. I am not saying anything to the contrary. I'm not doubting that. The issue is that at the end of one of these schemes, a much greater number of people will actually become losers, and the winners from one of these will be winners at the expense of those other people. So that's just something that you really need to go and have a think about. A lot of people pointed out in the original video that a prime reason for why Safemoon is a solid investment is because some of the currency is burnt, and I apparently missed that point out. In a recent AMA, it was mentioned that this burn has now been automated. Although since the protocol has actually not been updated, that doesn't really mean what you think it means. It just means that instead of having to literally press a button manually by the developers, they must have built some kind of script. And that's about it. The truth is, almost all of the burning that has taken place so far only took place when the first launch happened. In fact, on their own website, you can go and find this information. It is incredibly clear. 223 trillion tokens were burnt on launch. And in the first 2 weeks since the launch, when very few people were on board at that point in time, 99.5% of all the tokens that were ever burnt were burnt in that period. So since then, there's been pretty much no manual burning whatsoever. There's a myth out there that half or a quarter of the transaction fee is burned, and that's not the case. That is not how it works. The very short white paper that is also on their website makes it extremely clear. No tokens are burned as part of the transaction. 5% is redistributed to other holders, and 5% is split into 2 separate pots that go into the liquidity pool. Which brings me very nicely to the Certic Audit, because this is something a lot of people who hold Safemoon are extremely excited about, and they pointed it out a lot in the previous video. I was told hundreds of times that this audit proves that I am wrong. Well, let me show you. If you go and read the report, the disclaimer at the end specifically states that this report is not, nor should be considered, an endorsement or disapproval of any particular project or team. This report is not, nor should be considered, an indication of the economics or value of any product or asset created by any team or project that contracts CertiK to perform a security assessment. This report does not provide any warranty or guarantee regarding the absolute bug-free nature of the technology analyzed, nor do they provide any indication of the technology's proprietary business model, or legal compliance. Make sure you read it again, because this is incredibly important. It says this report should not be used in any way to make decisions around investment or involvement with any particular project. CertiK list what they do, what they look at the beginning of this report. In short, if you don't want to go and read it, it says that they basically go and review the code to make sure that the code works, and works like it is intended. It basically just checks that the code doesn't have errors. It doesn't assess the business of Safemoon in any way whatsoever. It's just a technical report. But if you read the report, they actually do have some big issues highlighted. And the one major issue is really big, and it shouldn't be forgotten about. What it really says when you go and read about that issue is that developers have direct access to the liquidity pool, and whoever has the keys to those wallets can do whatever they want with the tokens in there. This is something that I highlighted in the original video, but people who disagreed perhaps didn't quite read this CertiK report when they pointed that the report proves that I'm wrong. Now, the Safemoon team have made a long reply, which I can roughly sum up as, well, we won't do it because if we did, we would end up going to prison. That is an interesting argument because we have had many cases somewhat recently where that didn't stop people in the crypto space doing exactly that. Now, I am by no means in any way whatsoever saying, alluding, or implying that the team will be doing it. I do not know them. I know nothing about their background. I have no way of knowing whether they have any malice in what they are trying to do, but the risk is there. And the auditor, the Certic Audit that people are pointing to, is the one highlighting it. But then they also say that they have locked the liquidity pool for 4 years, the developers. But when I went and looked at the transactions they've provided, they have 4 transactions that go into 2 separate pools, and they only locked 41% of the first one and 33% of the second. Now, that's not quite the same thing as saying that they have locked those pools. So I think it's a little bit disingenuous the way that reply came about, but the same CertiK report also has a bombshell on something that most people probably wouldn't have read. It's the very minor SSL 13 issue. It only classes it as a minor, but it says that the owners can actually unlock locked contracts by following a short sequence of functions. Now, I am not technical enough with the specifics of this particular thing that they're doing here, but can that mean that they can unlock locked amounts? I don't know, but it certainly sounds like something that needs a little bit more of a response than what I saw there. As with pretty much every other recommendation in this report, the official response is the team acknowledged the finding and, given the deployed contract cannot be updated, decided to retain the code base unchanged. So, really important points here are you need to make your own investing decisions. You need to go and do your own homework. Do not listen to people on the internet, including me, to decide what you want to do with your money and where you want to go and put your money. But make sure that you do go and do the homework. Don't fall for FOMO. I am basing my opinion here based on the facts that I am presenting, and I am showing you why it is that I have this opinion, but that's just it. It is my opinion. You may have a different one, and you need to make sure that you're happy with your particular view. Investing in crypto assets is incredibly volatile and carries a huge amount of risk. You sure could earn a huge amount of money if you get in early, and a lot of people will. You also could lose a lot of money, and you can lose it in a few seconds. I hope you guys found this useful. If you have, please go and hit the like button because this video is going to get a ridiculous number of dislikes just like the last one. Thank you so much for watching. I really appreciate it. And as always, I'll see you guys later.